Good afternoon, everybody. My name is Mostafa Analoui with University of Connecticut, and today, along with BioCT, we are delighted to bring back the same panel that was brave enough to accept our invitation 2 months into COVID in May of 2020 and come and speak about so many uncertainties that we had back then. If you recall, March of 2020 was the beginning of the shutdown, and a number of our companies are really experiencing sudden effects of this market shutdown on the capital side as well as M&A. And we brought together a very fantastic group of investors that covered from very early to late stage of investment to ask their views as what do they see in crystal ball as a result of COVID. And to everybody's surprise, with no exception, everybody painted a very positive, optimistic picture. Now, almost 2 years after that period, we want to come back and you will see some quantitative data as what happened since then. And we're going to ask the same question, that seeing what we have learned today, what is it that they are anticipating, at least for the rest of the year in 2020? And we have seen very unusual scenarios. I just was reading that Pfizer vaccine was the best-selling drug ever by a mile compared to anything else that has happened in the past. So we never anticipated a single drug to be sold at $36 billion a year, which is about, I believe it's $16 billion more than the previous record that we had back there. So here's the plan for this afternoon. We are going to open with Don Hocevar, President and CEO of BioCT, who is going to say a few welcoming words. Then every panelist will introduce themselves, their organization, their fund, followed by a quick recap of market, IPOs, exits from last year by John Norris from Silicon Valley Bank. And then we open up with some questions that we have prepared ahead of time, but the rest of the time, the bulk of time will be dedicated to question by you, by the audience. I highly recommend keeping yourself muted. You're more than welcome to keep the camera on. And once we get to the Q&A section, we'll open up everybody's mic and you can jump in with your questions and comments. If the past is an indicator, it's very likely that you're going to run out of time. But considering that this is designated for an hour and a half, we bring it to a closure in exactly an hour and a half, but people are more than welcome to stay for any questions or comments that they may have. With that in mind, Dawn, would you please?
Sure. Thank you very much, Mostafa. I am Dawn Hocevar, President and CEO of BioCT, and we are thrilled to host this event again and are very excited, as I'm sure you all are, to hear how ROI investment is going to do in 2022. For those of you that don't know, BioCT is the voice of the life science industry in the state of Connecticut. And we work with all aspects of the industry, government, industry, academia, to help foster the growth. And we are experiencing a significant growth spurt right now. It's very, very exciting. And but I don't want to take up all the time. Everybody's here to listen to your investment recommendations and experience. So without further ado, Mostafa, please welcome to everybody and your panelists.
Thank you very much. So let's go through that quick introduction of yourself, your firm. And to be a good host, I start with those who are calling from the farthest distance. John, are you still in California?
Yes, I am. Yes.
All right.
Yeah, thank you so much, Mostafa. It's a pleasure to be back on the panel. John Norris, I'm a managing director with Silicon Valley Bank, which is a commercial bank, which also has a partner arm that's an investment bank. And what we do is we really focus on working with niche technologies. So basically, if there's a company that has a secret sauce technology across all different industries, we would love to be a part part of those banking discussions and be a partner with them from idea on a napkin all the way up through public and beyond. As I sort of focus on the healthcare side, and my role within the organization is I manage a lot of the venture healthcare relationships. And the idea is finding ways to be helpful to those folks. And about 11 years ago, I started writing a report that really looked at what's going on in the market. I think there was a lot of average numbers being thrown around, and it wasn't necessarily as exact as what healthcare folks would like to see as the type of activity that was going on in their sector. So we tried to put a report together that went into that a little bit. So that's what I'll be talking about today. But again, we love talking to companies from the very earliest stages and finding ways to be helpful partners. So thanks again for having me on. Appreciate it.
Thanks, John. Moving from California to Boston. Chris, please.
Sure. Great to be here, Mostafa. Thanks for the invitation. So I'm 30 years in the biopharma space. I worked at Gilead and Celgene and was public company CEO of Sarepta. But about 5 or 6 years ago, I started two firms. Well, one was Xontogeny, where we make seed capital investments, and we collaborate with early stage founding teams, entrepreneurs, scientific founders. And then I joined Perceptive Advisors to launch their venture fund strategy. We closed our first venture fund in December of 19, not too long before we had our last panel in 2020. And now we're on our second venture fund. We have about $725 million of assets under management. On that strategy, we're focused on Series A, leading and co-leading Series A rounds.
Thank you. Now coming to our local guest, Cyndi, would you please?
I was wondering how you were going to do that. Who's farthest from Tip or New Haven? Yeah, so Cyndi Green here. I am currently at Connecticut Innovations. I've been here about 2 years. Before that, I was at Pfizer in Manhattan. I led search and evaluation for vaccines and anti-infectives in the business development group. And I was there when Pfizer did the deal with BioNTech, which is how I say it. And I know that's not how everybody says it. That's how we said it when we were doing diligence. Before Pfizer, I was at a biotech company in New Haven called Curagen, which had a great rise and a fall that wasn't too quick, but it no longer exists. Before that, I did my postdoc at Yale. I'm a molecular biologist. I did a business degree, RPI, actually the satellite location out of Hartford. So I am back in Connecticut after 16 years at Pfizer, took early retirements, and started working with Connecticut Innovations, which is Connecticut State Venture Fund. I know a lot of you probably are familiar, but we are a quasi-public agency. We invest across the board. I'm part of the bio team. We have about 4 people on the bio team right now. Our portfolio is about half and half. We do a lot of little deals. So we do a lot of pre-seed, seed stage, early Series A, and then however long companies will let us ride along. We invest we have probably almost 300 companies in our portfolio right now. So we have a big portfolio. And I can talk a little bit more about that when we get into the Q&A, but happy to be here and looking forward to the discussion.
Thank you, Cyndi. Marianne Rooke, please.
I'm Marianne Rooke, and have a little bit of background. Spent 20 years in Silicon Valley and moved back to Connecticut 20 years ago, believe it or not. It's amazing that it's been 20 years, but my background was in finance, worked in the corporate world and then in the startup world. Have been a member of Angel Investor Forum for the last 17 years and have been president for about 12 of those years and just stepped down so I could do a little bit more traveling. And as still on the board, I'm one of the administrators for our upcoming Angel Investor Fund 4 that we are just raising. We've been invested in our investment focus areas, pretty much just about everything: biotech, medical devices, consumer products. Most recently, we've been getting into some consumer products, a lot of software. We do a lot of syndication with Connecticut Innovations, with a variety of angel groups throughout New England, New Jersey, New York. And also I work closely with Mostafa as one of the fund managers for UConn Innovation Fund. And, I'm happy to see that on the call today are many of the companies that that UConn Innovation Fund has invested in, as well as Angel Investor Forum has invested in them. So happy to be here.
Thank you, Marianne. Our next panelist is Colleen Cofaro. That she has a last-minute unexpected engagement. Despite that, she was gracious enough to come, and she's going to go through a more extended introduction of herself, the fund, and because she cannot stay for the whole program, she's going to tell us ahead of time everything that you were shy to ask. Colleen, go ahead, please.
Mostafa, my camera has been shut off and I can't turn it back on myself. I don't know if there's a way to do that. Otherwise, I'm just the voice of God right now. I'm trying to start my video, but it says the host has disabled.
Apologies, Colleen. Let me sort that out for you.
No problem.
I'm very sorry about that.
No problem.
There you go.
There I am. Okay. Hi, everyone. I'm Colleen Kafara. I'm a partner with Canaan. And I've been with the firm for 8 years. So I'll do my personal background first and then tell you a little bit about Canaan. So prior to my 8 years with Canaan, I'm a scientist by training. I did my PhD training here in the state of Connecticut at Yale in the Department of Cellular and Molecular Physiology. And I had started my career in industry working as an analytical chemist at a small contract pharmaceutical manufacturing firm that manufactured small molecule-based drug products, everything from preclinical feasibility work through commercial drug supply. And since joining Canaan, I've focused on early stage biopharma investing, mostly seed and Series A. So Canaan's a traditional institutional venture fund that's been around since 1987. We have our roots here in the state of Connecticut, as the firm initially spun out of GE Capital in the late 80s. And the name Canaan actually comes from New Canaan, Connecticut, where one of the founders lived. The firm is a diversified fund, so we invest in both tech and healthcare out of the same fund, and we're currently investing out of our 12th, which is an $800 million fund. As I said, I sit on the healthcare side and focus on biopharma, where we invest in early stage deals, mostly seed and Series A, across modalities and therapeutic areas. So would you like me to just jump in, Mostafa, or you have specific questions for me?
No, I think the comment that I'd like to hear from you, and unfortunately we're going out of order, is at least from the Canaan perspective, how this COVID has impacted your portfolio, your thinking, and what are the pleasant and unpleasant surprises that you have experienced since last time we spoke?
Yeah, so I think last time I mentioned that when everything first got shut down, I had a bit of a worry that we were heading into a recession and things were going to get really difficult. And then when we spoke in May of 2020, actually it became clear that that wasn't the case, and we were continuing to see a very healthy investment pace. And I apologize for making this panel go out of order, but we haven't had the benefit of seeing John's data. But I can tell you, I'm always on the edge of my seat waiting for John's new data to come out and look at his reports, because they really capture what we're witnessing in the market quite well. And what we've seen, over the past 2 years has just been, as you'll see from the numbers that John presents, unprecedented pace. And I think one of the factors is that COVID has made us all work from home and switch to this, Zoom life, and it allows you to stack back-to-back meetings, and there's not this travel between meetings, and there has been a bit more ease of scheduling because everyone's working remotely and the workday is essentially extended. Additionally, there was in the biopharma space a very, very healthy public market that enabled returns, that allowed people to go back to the wells and replenish their funds. And so we just see a lot of very topped off venture funds with some new funds popping up, and just a lot of dollars available for early stage biopharma. So it's just been unprecedented pace. And I would say, looking back at 2021, the first half of 2021 in particular felt like the peak for me. Personally, the pace of deal movement was unlike I had seen it before in my 8 years. So typically we would have a couple of months to do our diligence and move to a term sheet. Things were now moving on the pace of the order of 2-3 weeks from first meeting to expectation of term sheet. The dynamics we were seeing in biopharma really honestly mirrored what is typically seen in tech, where it's very competitive. Companies are receiving multiple term sheets, and it's a very much a seller's market. So I feel like that was my experience in the first half of 2021, and things have quieted a bit, but not substantially, I would say. And even as we're seeing the biopharma public markets come down in value significantly, I have not witnessed that trickle down to the early stage company creation and seed and Series A deals yet. Again, coming back to all of the fundraising that took place. So you have all of these venture funds with a lot of money that has to be deployed. So we're still continuing to see a very, very robust pace, I would say, of new investment activity in the early stage arena.
Thank you. Colleen, the other observation is, because of so much capital, there seems to be a very oversized rounds coming in at unusually high valuation. Again, John's data will tell us whether that observation is correct or not, but do you think that is sustainable moving forward?
Probably not, because of course the job of venture investors is to generate returns, and our exit values have to scale in order to make those higher valuations and larger rounds work. And as John's data will show, we actually did start to see, pre-money valuations on IPOs go up. We actually start to see median M&A upfronts drift up a little bit. And so you can start to make the math work. But as those early stage rounds gets bigger and bigger and bigger, if your exit value doesn't scale proportionately, you're compressing returns, and over time it doesn't work. So I think that we will see a bit of a regression back towards more capital efficiency. I certainly hope so, because it's challenging, to do my job and make the math work. When you're raising such large rounds, it puts a lot of pressure on the exit. You need multi-billion-dollar outcomes to make the math work.
Yeah. And the last question before I let you go is, your fund is unique because you have life sciences and technology. I know that you're on the life science side. Does the technology side feel the same way in terms of the massive amount of capital being able to deploy?
Yeah, so I think there are some significant differences between tech and healthcare. And one of the noteworthy differences is that tech companies tend to raise less money because they tend to be less capital intensive. And so if you think about a tech company that is immediately generating revenues or generating revenues at a very early stage, they can offset their burn rate. And I think many of us here on this panel, and I'm sure in the audience, can appreciate how capital intensive drug discovery and drug development is. And that's just a fundamental difference between our sectors that drives some of the very large rounds that we're seeing on the biotech side. So while I think it has been, there have been some parallels in the tech market with high valuations and a lot of fundraising activity. That means it is very much a seller's market and very competitive to get into early stage deals. Again, the rounds tend to not be as big, especially on the early stage side, just because of the fundamental differences in the sectors and the capital needs of our businesses.
Well, thank you very much, Colleen. I know that you're very busy, and it was very gracious of you to come and join us. So
thank you so
thanks
much
again.
for having me.
Sure. Now we're going to go back to our regular scheduled program, which John is going to kick off with his presentation. As John mentioned, this is every year on a regular basis. Silicon Valley publishes this, but when we were going to JP Morgan in person, everybody wants to know, where's Silicon Valley Bank annual data? We want to have those numbers before we go to the meetings. And based on what you will hear, what I'm thinking, John, is we have to change the definition of unicorns from now on, because unicorns are supposed to be things that you don't see very often.
Fair enough. That is a very fair point.
So floor is yours, John. Go ahead, please.
Great. I think I'm going to share my screen here and march through some slides to give you a sense of what we're seeing out in the market. And Mostafa, can you see a full screen, or does it look like a presenter screen?
I see the full screen.
Okay, perfect. And so, what I wanted to do is talk a little bit about what we're seeing in fundraising and on the investment side. And we'll go through each of the 4 categories that we cover between biopharma, medical device, health tech, and DX tools. And we'll do a little bit of a deep dive in computational biology, because I think that is a super interesting area. Then we'll look at M&A and IPO activity. It shows a lot of slides here, but my intent is to give you just a good taste of what we're seeing and go through this very fast. And so, there's always opportunity to come back if you have some detailed questions to talk with me later about it. So with that, I think we'll just get going. This first slide looks at healthcare venture fundraising in the US. And basically what we're doing is we're looking at every fund that gets closed where more than 50% of the investments are going into the US. And if it's a firm like OrbiMed, where 100% of their investments in healthcare, we count it as 100%. If it's a Tiger Global or an Oak or a Bessemer, we try and approximate how much healthcare dollars are actually going to deploy in their fund. So that's the numbers that you're seeing up and to the right. And you can see over the last 2 years, just because of the exit environment that we've seen on both the M&A and the IPO side and the aggressive investment velocity, we've seen a lot of funds come back out to the market and raise. And not only raise their new funds, but also raise opportunity funds on top of that. And so $28.3 billion in 2021 is far above any other year we've ever seen. And if you sort of combine the 2 years, that's over $40 billion just from venture capital. And I want to just make the point that, when you look at just venture capital, these are folks whose sole thesis is to invest into healthcare, early stage as well as later stage venture-backed companies. So that's a lot of capital. And you sort of think about it, that's $40 billion over the next 3 years to invest into new companies, and then to support those companies over the next 7 to 10. So a lot of dedicated capital in the market. That's over and above what we might say are folks who are dipping their toes in the water in healthcare or tourists, et cetera. A lot of dedicated capital. And then if we look at where those dollars are going on a quarterly basis, I think when we spoke about things in May of 2020 in Q2, we were wondering what is in store, but we felt very good about the pace and trajectory of healthcare. And we've seen what's happened since. Q3 was a record quarter in 2020, a very solid year that was far and beyond any year, 2020 versus any other year. But then 2021, we just took off. And if you sort of think about it, in 2021, there was $86 billion invested into venture-backed healthcare companies in the US and Europe versus just $16 billion in 2017. Just a huge increase. And it was kind of across all sectors, but I thought it was very interesting is really biopharma and health tech really were pushing the ball forward. But what was interesting to me, based on a really, really explosive Q1 of 2021 for biopharma, we did see a decrease quarter over quarter in 2021. And I think that's really being led by some of the less active crossover rounds that we saw in 2021, but I'll talk about that a little bit further in the presentation. So let's start with Biopharma. On the Series A side, $7.9 billion just in Series A financings in 2021, just a crazy large number. And that was really being led by platform companies, which are so early stage, they're not even sure where they're going to focus, as well as we saw a jump up in anti-infective investment. It was interesting to me that for the second year in a row, we saw a decline in orphan rare investment in seed and Series A, which I thought was very interesting as well. And we did see another, we saw $50 million or bigger investments that were in comp bio deals, which we're talking about in a moment. But overall in the sector, again, a very big year for biopharma, led by platform as well as oncology deals. And again, platform deals are so early stage. A lot of them end up being oncology, which is where a lot of folks focus. But we continue to see a decrease in orphan rare investment as well. But the thing I really wanted to focus on in this slide is what I have in the red box, which is what I call the Lipo deals. These are sort of the likely to IPO deals. These are deals where their top 15 crossover, which are these opportunistic funds that are sort of publicly minded, but opportunistically investing in healthcare venture funds. These are private deals of at least $40 million where one of the leads are one of these crossover funds. And you can see the number of Lipo deals that we saw on a quarterly basis. In 2019, they were in the low to mid teens. In 2020, it was 20 to 30. In Q1 of 2021, we saw 48 deals just in the first quarter that were $40 million plus, sort of these mezzanine fundings. But what was interesting is you saw a significant sort of decline as you went forward into 2021. So there's less and less of these deals happening. And the reason behind that is even though the IPO market has been very frothy, we continue to have a buildup of companies that are still private. Now, there's a little bit of overlap with some of these deals that have done one mezzanine financing, then another one on top of that, but that's probably about 10%. So if you look at this number, there's still, of these Lipo deals, 120 are still private, even though we saw like about 115 already go public. And the issue there is if these crossover funds have these deals where they've invested in the private market and they can't get public, the question is, are they going to continue to invest in the private market? And the answer is, I think they're going to cool their heels while they figure out what's going to happen with the deals that they have that are still private and haven't gotten to the public market yet. But I'm sure Chris will probably have some perspective on that. So we definitely are monitoring that. And I will say, just to give you context, we've seen so much investment by these late stage crossover investors. The top 5 crossover investors have done more deals over the last 2 years than the top venture investor, just to give you a sense of the activity level that we're seeing. And what's also interesting on the geography slide, and I'm sure Chris will smile at this from the Boston side, Boston is really dominating in terms of dollars invested into biotech. I think they started to separate themselves a little in 2020, but they have just dominated the sector, both in Series A and late stage. So Bay Area is now definitely a far behind number 2 to Boston in terms of dollars invested into the biopharma sector. So then let's spend a little bit of time on health tech. This is the full investment within health tech on a yearly basis. And I think if there's anything that we've seen over the last 2 years, it's sort of the embracement of sort of the alternative care model. How are you going to interact with patients outside the hospital? And how can you do that in a way where the patients will have a good experience? And I think a lot of people never wanted to try that because they didn't think the experience was going to be good, but they were forced to do that through the pandemic. And that's really where you've seen a lot of the activity on the investment side in health tech, especially in these alternative care sector, which we kind of looked at both as virtual care as well as hybrid care, which is, you're doing some things virtual and you also have brick and mortar. You're seeing a ton of investment there. You're also seeing a lot of investment within the provider operations, which is really, finding ways to digitize this practice so that you can have better patient engagement. And that's really where you're seeing a lot of that investment. And Mostafa and I were talking about this before the session started, but when we talk about unicorns, which means basically a private company, which for the first time has raised a round where they're valued at $1 billion or more, again, unicorns used to be very hard to find. And actually in 2020, there were 9 health tech unicorns that happened. In 2021, there were 43. So just let that sink in terms of, and these are all just for the first time hitting $1 billion or more. What was also interesting is I think when I looked at the highest valued companies in 2020, the highest valued private companies in health tech, I think it was Bright Health at $4 billion. That was the #1 highest valued private deal where you had a public, at least it was disclosed public what the valuation was. That company would not make this list this year. All the other companies are valued at more than $4 billion, just to give you a sense of the scale. And why is that happening? It's really because you're seeing some of these really late stage investors jumping into some really interesting technologies. And so you see the folks like Tiber Global and SoftBank and BlackRock. And how do they get into really high performing companies? Well, they make really significant investments at really intriguing valuations. And so that's kind of what we're seeing on the health tech side. And just to give you a sense by geography, Bay Area and New York are really where the lion's share of the investments happening in health tech. But I will say Boston has more than doubled just in from 2020 to 2021. So a lot of activity there as well. So on to DX tools. I think what's interesting to me is in Series A, even though if you look at overall for DX tools, it's the third biggest sector in terms of dollars invested. They're actually the last in last place in terms of dollars raised for Series A. So while we saw a really big uptick in like DX tests and things along those lines in 2020 with the pandemic and the idea around testing, et cetera, we're still seeing a lot of DX test investments, but those investments are really small. I think you're continuing to see a lot of consumer demand for home testing, and you're seeing those companies start up, but the dollar amounts are, as I said, a little smaller than what we've seen in the past. R&D tools really does sort of dominate the sector when you think about deals in dollars. And if we look at overall within DX tools, R&D tools really does, again, the lion's share, 6.5 billion of the 13 billion in R&D tools, with a significant number of really large deals with correspondingly high valuations. It's going to be very interesting to see what happens with these over time. I highlighted over on the side, some of the more active investors that we saw in the second half of the year. I will say that we did see anecdotally some valuation pressure on the DX tool side, especially in DX test and R&D tools towards the end of last year. And so it's going to be interesting to see if that continues or not. And by geography, Bay Area is the leader, with Boston and New York also doing significant amount of investment. And then finally on to device, where we actually, even though they didn't raise as much overall in terms of dollars invested in the companies as DX tools, in Series A, they actually did. And so, which is really welcome to see, medical technology getting a lot more investment. And it's really being driven by what I call sort of tech-enabled services. And so these are either non-invasive monitoring, which is sensor-based technology where people are wearing and having their vital signs measured in some sort of way, usually on the cardiovascular side, to help keep patients out of the hospital, but also on the imaging side where, hey, this is a way that we can leverage the type of surgical opportunities that we can, where these are sort of big money makers for hospitals. If you can leverage imaging to make these surgeries better, then that's also very intriguing. So we've seen those sort of lead the way on the Series A side. Overall, again, a lot of investment there, but a lot of late stage investments in neuro as well as cardiovascular. And this is to me very intriguing because we're going to see these are a lot of almost pre-IPO type rounds, Series C, Series D rounds. It's going to be very intriguing to see if these folks go the route of potentially on the IPO side or M&A. And it really is going to depend on where we see the market on the IPO side, which we'll talk about in a moment. And then the last little piece on device, on the highest valued private company side, there's actually a number of these companies that don't even have revenue yet, which again, for biopharma, we don't talk about revenue, but in device, we do talk about revenue. So it's very interesting to see a lot of these companies may be a little bit ahead in terms of valuation for where they are on the revenue side. It's going to be intriguing to see, because we've seen a little bit of a pullback towards the end of the year, how these folks are going to do on the valuation side. And then geographically, the Bay Area continues to sort of dominate on the device side. I just wanted to sort of point that out, with the Boston area, second behind them. So here I wanted to do a little bit of dive into computational bio. And we looked at Series A deals from 2019 on, actually seed and Series A. We looked at all therapeutic deals and then all R&D tools deals and tried to say, is there a focus on drug discovery or development? Have they applied some sort of novel computational tool to either gain biological or chemical insight? And then is there a platform for that company? And then is there a team with computational experience on that company's sort of team? And we've seen so much of this activity recently. You can see from 2020 to 2021, a real jump up in investment in computational bio. A lot of these are focused on sort of small molecule antibody and sort of led by the Boston area as well as Northern California. And what's interesting to me is, we're seeing both on the biopharma side and the R&D tool side, pretty small deal sizes for these deals, but, decently healthy valuation and not really a huge difference between the two. Yet you're seeing some of these companies on the investor side that are tech-focused companies as well as healthcare companies sort of leading the charge. And I think this is a very difficult area for folks to invest in because you're trying to underwrite basically an algorithm and data set, with expertise. And that is not an easy thing for your traditional biotech investor to invest in, which is why you're seeing folks like Artis Ventures and DCVC Bio and Lux and 8BC, et cetera, being a little bit more active in this arena. And if you look at sort of the end game, we looked at all the comp bio companies that IPO'd since 2019 that are valued at over $1 billion or more at the IPO. And of those 13, the average performance was plus 56%. Actually, I'm sorry, the median post-IPO performance was plus 54%, which you cannot group another group of IPOs since 2019 that are 13 companies and find anything close to a plus 54%. So you're getting a lot of value in the public market. You're not as much on the private because I think big pharma really wants to see these computational bio companies get into the clinic and have really good results and get to phase 2 data before they might be willing to jump. Although you did see a company, Vividian, that was acquired earlier in 2021 for $1.5 billion up front. So a lot of real interest in computational bio. We're going to continue to monitor that quite a bit. And then let's go into the sort of last part of the presentation. And that's really getting into what's going on the IPO and M&A side. In biopharma, 92 IPOs. We've never seen that many IPOs. M&A sort of a little bit smaller because so many folks had raised these huge mezzanine rounds to think about going public. And so that was really the focus. We saw a similar amount of value created in terms of IPO market caps and M&A as we saw in 2020, but the performance on the IPO side obviously really kind of struggled. And that really struggled, from the outset in 2021 or 2021. And if you look at the biggest IPOs that we saw and the sort of performance from IPO price to end of 12/31, and I think there was obviously a little bit of give back from 12/31 to now even, a lot of negative numbers here. And so M&A continues to be a bright spot, but really for preclinical deals. So private M&A is really dominated by these preclinical deals where most of these deals are like $30 million in or so, and you're getting upfronts of 300 million. So the 10x upfront sounds very good, but the minute that you start to contemplate that big crossover round and all of a sudden you have 100 million in at a 350 million post, it makes it a lot more difficult to transact. So on the early stage side, we are seeing some big deals. And actually, frankly, there were 3 deals, Vividian, Teneo Bio, and Immunix, all were $1 billion plus upfronts and on all super early stage companies. So we are seeing that activity, happen, but most of these deals are really going public. And we did see a little bit of a decrease in the pre-money valuation in 2021, as well as the dollars raised in your IPO. But the performance overall was negative 21% for the year. So really, obviously, 2019 and 2020, I think was close to 75% 2019. And I think 2020 was the average performance was plus 100%. So a huge sort of give back a little bit on the biotech side. But what was interesting is I did sort of look at the IPOs that we saw in 2021, about half of them were super early stage, preclinical and phase 1. And so it had me wonder, like, over the last few years, all these early stage preclinical phase 1 IPOs, how have they done over time? And what does that look like in terms of performance? And it was very intriguing because when you actually do the math on that, the median performance is actually just as good, if not better, than what we saw from late stage IPOs. And so the step-ups are better for early stage and the performance is a little bit better. It makes me wonder, to the extent that I've heard commentary of, oh, maybe there's not going to be any early stage IPOs in 2022. Yet when we look at the data actually shows that the performance is not bad. So it'll be interesting to see what the investors think about this going forward. And then on to health tech. A lot of IPOs happened in 2021. More than double what we saw in 2020 and 2019. Yet the performance in health tech was almost, was even worse than what we saw in biopharma. The top two IPOs, Bright Health and Oscar, both were down 80% at the end of the year. The bright spot was Doximity, which was up almost 100%, but a lot of red numbers here. And so, the IPO route has not been super successful out there, but we did see an increase in M&A. And while the total deal median is not necessarily increased, we saw a good amount of $200 to $400 million deals being consummated out in 2021. We also saw a number of private, really well-funded companies. We saw that slide where the 43 new unicorns. There's a lot of companies with a lot of capital, and some of those private companies are actually acquiring other venture-backed private health tech companies. So we saw some of that activity as well. And then finally, we have two more sectors, DX tools. Just, the promise of exits in DX tools really sort of came through in 2021, where you saw, private M&A go from 11 to 25, IPOs from 10 to 30. The potential exit value generated just substantial. And, it's really the promise that was from a lot of investment that we saw in 2018 and 2019. Really culminating into some good exits. While the IPO market was not great, and in fact, again, you're seeing, a number of fairly large red numbers in here. R&D tools IPOs were up an average of 25%, while DX tests have actually struggled a little bit. They were down 26% in terms of IPOs in 2021. So, I think overall, the IPO market has come down in terms of valuation from where the expectations are. And I think multiples are being a little bit more compressed in the DX tool side. But we are seeing really good activity on the M&A side. And if you look at the three sectors that I cover, which are DX tests, which are unique yes/no tests, versus R&D tools, which is sort of you're selling into biopharma and academia, and then DX analytics, which is basically actionable data that helps a physician make a decision on the clinical side. All those areas saw significant M&A. So it was great to see, that type of activity. We didn't see the billion-dollar exits that we saw from like Grail and Thrive and Archer DX that we saw in 2020, but we saw a really good number of $200 to $400 million exits, which, based on the dollars that we're in, actually seem to be very good exits. So feeling good about the DX tool sector. And then on the device side, again, upswing in M&A and in IPOs. The IPOs, especially in the US, really struggled. We saw a number of China IPOs who actually did well. The US IPOs have not done well. And so even though when we look back on it over the last 4 years, the device IPOs actually performed better than any other sector out there. This year in 2021, when we look back on it, it was a little bit of a struggle. But on the other side, M&A was up very nicely. When you see the median upfront and total deal value up, but we saw what was interesting is a whole new class of acquirer. We saw these small to mid cap companies that all of a sudden realized that they went public and now they have to find an additional technology. We've had two different China companies coming in to acquire venture-backed companies. And then we saw some of the big guys jump in as well as folks that were big healthcare conglomerates that sort of spun off the device side. Those folks were acquisitive as well. And so these small to mid-cap companies starting to buy companies, but also starting to invest in venture-backed companies is really forcing these big guys to sort of jump in a little bit faster. And so we are seeing, some nice investment or exits on the non-invasive monitoring side, which is catching up with the investment that we've seen over the last few years. But we've also seen increased dollar values for both PMA pathway companies and 510K clearance deals. So again, good things in device. And then finally, just to end on, what do we think is going to happen and beyond? Just a little sneak peek. I'm sure we'll talk about more of this with our esteemed panel. But venture fundraising, I think, is going to come down pretty significantly because most of the funds have not only raised their most recent fund in the last year, but also their opportunity fund. And I think pace is going to slow down a little bit. And because of that, I think, where we used to see 3 to 4 year time periods between fundraisers, and that got compressed to 1.5 to 2 years, I think it's going to extend back out. On the biopharma side, I think we're actually going to start to see more Series C deals. It used to be, the last 2 to 3 years, it was either seed or Series A. You raise that crossover B, and then you're public. I think there's going to be a little bit more investment there. And I think the crossover investors are going to continue to be on the sidelines. There will be firms that continue to do investments, but I think there's going to be a number of them that are cooling their heels. And so my prediction is IPOs will be down 50%. And so that gives you, around 50 IPOs or so. And I think M&A is going to be up, but I think it's going to be more for the public companies because when you think about the public market, that's where you actually have valuation that gets affected by sentiment, right? On the private side, you have all these mezz fundings at evaluations that now seem inflated based on where the market is. Whereas the public market, a lot of these newly public companies have to raise more money in the public market, but their valuation is depressed. And I think there may be opportunities there for big pharma to be focused more on there than the private side. But I do think there's going to be some early stage private M&A as well. Health tech, a lot of consolidation is what we're predicting in 2022. A little bit less investment, but a lot of consolidation. And on the DX tools, again, good exit environment. M&A will remain strong. I think IPOs, the valuations are going to suffer a little bit. I think that's going to be the same in device as well. But with so many acquirers out there, I think we're feeling pretty good. And so with that, Mostafa sort of gives you a sense of the world as we're seeing it. I'll sort of defer back to you. And thanks for your time and thanks for letting me give you our overview.
Thanks, John. Thanks for the comprehensive overview, which really gives a good backdrop for our conversation. And I suggest our panelists jump in if you have any question or a comment about the data that John presented. I start with the first question, John, to you, because part of your data showed that crossover investors like RA have been very active, even some of late stage generalists like SoftBank's very active. Do you find them as a part of the reason for this unrealistic valuation set in the market, which is difficult for early stage companies to catch up with?
That's a great question. And I think, how I would answer it is it's not unrealistic when everything works. And I think over the last, 4 to 5 years, the valuations have been justified in the public market because, these companies have had step ups into an IPO and then great performance. And so it's always great to justify that until it's not. And I think, it is being led by some later stage investors. And I think there's a difference between the types of investors. And I think it'd be great to hear about other people's perspectives on this. And I think what's going to happen is you're going to see a shakeout in what I classify as my top 15 crossover investors. Some of these folks have dedicated venture funds, right? And these are the folks that are going to be sticking it out and have sort of long-term perspective on the private side. The other ones who are more opportunistic, they're going to have to deal with the ramifications of having some tougher performance over the last 6 months or 8 months.
Yeah.
And that may affect their ability to do deals in the private market. So I do think the crossover deals are going to be down, but I do think that the crossover investors that we've seen out there in the market for the last 7-8 years that have that dedicated practice and expertise, I don't think they're going to exit the private market in total. I just think we're going to see less activity.
Yeah, thank you. Chris, you saw the data. Boston was doing very well, at least on the biopharma side. Do you have the same feeling that when you walk down the streets or the virtual streets of Boston's and Cambridge area?
Well, I mean, what was great about John's report this year was he went really deep into the different sectors. And I think that's where you start to see some differentiation across different types of investors who will lean into certain subsectors. Geography dictates that. I think Boston has traditionally been focused on some of the newer cutting edge drug technologies. And I think that is what you see is that, there's more and more of those opportunities to invest in. I think a lot of the Boston-based VCs did close, bigger funds. They are investing more capital. And so I think that's what's indicative of that kind of growth over the last few years. But look, I think at the end of the day, the traditional priority for a venture investor always comes back to the basics, which is how do you take that early capital and create value for your private, enterprise? And I think what we've seen with the speed to the mezzanine round, the speed to IPO, is we've lost a little bit of that discipline of, well, let's take this first Series A round and let's create a lot of value, as opposed to artificially getting a step up, raising more capital. The good thing of that is that when you can bolster your balance sheet and you have a lot more runway, that's a good thing for the industry, right? But we also know once you go public, valuations are different and you can be penalized, or if you don't have a catalyst event coming. And so I think that is the downside of going public. I mean, we talked about unicorns, but the real news story is how many public companies are valued at $1 billion, because sometimes those don't even require much capital to get that type of evaluation. And so I think we've just seen a kind of a new watermark over the last few years in terms of, comparable valuations. And I think that's come down significantly. Now, venture usually lags that. You don't have to mark, quarter to quarter if nothing's really changed. And so you go with the latest investment. But I think we're going to see a kind of a return to some more of that discipline. And the reason it is that any venture firm will look at their portfolio and ask themselves, okay, how do we exit? How do we create a liquidity event? And when is that going to occur? And if they start looking at their portfolio, and let's say around over 20 companies, 15 of them are preclinical, well, they know that those are unlikely to be acquired through M&A, right? There's no real drug on the horizon that's going to generate revenues. It's going to be very dilutive to any acquirer, right? That's going to, create a drag of R&D expenses on their earnings. And so that's why you don't see a lot of early stage, particularly preclinical platform technologies get acquired. You might see strategic, creative structure deals, but you don't typically see M&A. And so if these companies that traditionally were thinking, okay, 15 of those 20, I can get most of those public and that'll create a liquidity event. If they're thinking, well, maybe I can get 3 of those to go public, right? Well, now they're going to start to think about, all right, how much capital do I have to get to a real value inflection, to get to, let's say, clinical proof of concept data that might make it attractive for a pharma company or a big biotech to come in and acquire. So I think you're going to see that shift to really start to think about how do we use the balance sheet we have on these private companies, and how do we get to something that might be attractive for M&A. Now, what was the most encouraging from John's presentation is how much M&A was occurring in the tools and the diagnostic space and the devices. And that's very encouraging for those subsectors. But for drug technologies, that never really happens quickly because they realize it's a long time before they can get to a product that's generating revenue. And the other dynamic that could be happening, while I agree completely with John's assessment that traditional hedge funds that have been doing private rounds, they're not going to go away. They're still going to find opportunities to invest. However, some of them have restrictions on how much private capital they can put to work out of their hedge fund. And so if you have a hedge fund that was trading at $8 billion of AUMs, that leaves a lot of capacity for, let's say 20% can go into privates. Well, now if they've seen those AUMs go down to 4 billion instead of 8 billion, and they've got a pipeline that's been, clogged up and they can't get those companies public, all of a sudden they have sometimes restrictions of how many more privates they can do without getting some of those privates public. So I think that's where I think they're going to start to focus more on, okay, let's look across the public company carnage, right? And let's do what we've done well for 20, 30 years. Let's start making some good bets and investments in the public equity companies. I'm sure there's value that's, oversold that they can find, and they might see a company up 200% or 300%, right, in the next year. And I think that's where you start to separate those who've been doing this for a long time, who haven't lost their edge at picking really good companies in the public markets. And I think they're going to focus less on trying to create the hedge fund value by, hey, that 30%, 40%, 50% step up from the last round, where they were driving a lot of their returns over the recent years.
Thanks, Chris. This was really detailed answer, which was wonderful. The other issue that you highlighted, venture assets being a different class asset within the hedge funds and even LPs, as the valuation becomes out of whack, there'll be some adjustment that could impact the size of funds to be raised, just like what John mentioned is one of his predictions for next year. Cynthia, I want to come to you because your fund is with 300 portfolio companies. You are, in terms of number of companies you're investing, you've got a very large portfolio, but you're at the very critical stage of investment decision-making, early stage ones. Now, how do you see the landscape evolving for CI in last year? Because last year was the full COVID year that we had, and how that has impacted your investment strategy moving forward.
Yeah, well, I think first, John, thanks so much for the presentation. It's really great to see all that data. My head's kind of spinning here. But I think from a CI perspective, we're definitely seeing kind of things go up. You talk about valuations, we're definitely dealing with that. We wonder, is it sustainable? All the questions. Look at what the market's doing and think, it's gonna have a trickle down effect, right? And so I don't know if it really changes our strategy, but it definitely makes us very thoughtful, maybe more thoughtful than usual. Not that we're not already, but just looking at the company that we have made an investment in. Have they been able to do what they said they were going to do, and are they able to get other dollars? I mean, we don't really make any of the follow-on decisions by ourselves. It's all going along with other firms, and what can we believe in, and how can we be supportive if they aren't getting more interest. So I think just continuing to be selective about what we follow on is very important. And not everything survives. I don't want to talk specifics, but we've had to kind of wind things down for in a couple instances. So I think that there's always going to be kind of the ebb and the flow, and hopefully we're picking good things to begin with. I can say from a deal volume standpoint, we're busy. I'm going from meeting to meeting, and even though we really only play in the state of Connecticut, we do look at some things that might be overseas that might be looking to come to Connecticut. We spend a little bit of time there. Trying to retain companies here is one of our goals. We've tried to be a little bit more flexible with some of our models if it's something that we really like early on, and maybe they can't commit right away, but they're willing to work with us, and with the understanding that if we stay along, they're going to make that commitment. And I think it's just it's busy. It's busy. We're hiring. We are bringing on board a couple more people for the bio team, and also looking for interns. So if anybody has ideas, feel free to ping me. Just trying to keep up and maintain, and try to be selective. I think it's it's getting interesting here because we've been doing this not a super long time. And I say I've only been here for 2 years, but we have a very experienced team. We have a lot of what we're seeing now is repeat entrepreneurs who they have been there and they have done that, and they come back and they have an idea and they have a great team, and they have other people who are going to put money in, and you take the bet or you don't. And I think I can't help but see what we're seeing and wonder also if we're getting a little bit better at this. I mean, you can look at the dollars and you can look at, what's attracting money and what's getting bought. And, the FDA approvals, I think have gone up a bit, but I mean, overall, are we doing better? And is all this money, making a significant difference at the end of the day? Long-winded answer and ending with a question. So.
Appreciate that. I think I have worked with CI for quite some time. I sat on your board for a number of years, so I've seen the inside and outside. It's a very challenging area to be at that particular boundaries of the seed to Series A and B investment that you get engaged. An even more exciting part is when Marianne is sitting as Angel Investor Forum is the largest angel group in the state of Connecticut, and they co-invest with New York and Massachusetts and others. Marianne, so from AIF perspective and the number of deals that you have done last year, how do you compare 2021 with the prior years? What has been the impact of general COVID in your investment strategy? Number of deals, size of deals. Can you share with us, please?
Sure. Well, I have to echo a little bit about what Cyndi just said. We are busy and we're growing our angel group. And it's interesting if you think about when we met 2 years ago, when we were on this panel 2 years ago, we were all just really kind of worried what was going to happen and where are we all going to go. What we found is that we've been on Zoom meeting. We didn't skip a beat, and we actually didn't skip a beat in investing either, because we have good deal flow. One of the, I guess, unintended consequences of being on Zoom is that, which was positive, which it really allowed us to expand our deal flow to other geography. Not our geography generally was New England, the Northeast. Now, we've really been able to expand it quite a bit more because we're now using Zoom. It's also allowed us to grow our angel group. We now have some members, increase some members from Boston and from New York region and Florida, because people can join us that way. We're not just meeting in person. So last year in 2021, I think we added 15 more members and growing. So we initially had some deal flow issues because companies, I think, were shocked and trying to figure out were they even going to survive, and would they even be raising capital, and what was the COVID thing going to do to their planned business strategies and execution. We have, many of the companies that CI invests in, we invest alongside, as well as with UConn Innovation Fund. And in 2021, there were some additional investments needed by those companies just to bridge, some bridge investments to get them through to their Series A. And it's happening. We're happy to say that our portfolio of companies, we have survived. Our funds are still, I think one of our fund 2 just had an exit with one of their companies, and the other companies in the portfolio are still surviving. So one thing we are seeing is that with many of the companies in our portfolios, they are looking to extend their maturity dates of their convertible notes because they're putting off, or they found that they really needed to put off their Series A only because they were having a harder time connecting with investors. But I think that has dissipated now. And and valuations continue to go up, which amazes me. But I think it amazes everyone, right? In the very early stage, we're seeing valuations increasing, and that's I guess that's a good thing, because that means that there's money out there and people are buying in at those valuations. So money is flowing, and that's what's important to the early stage companies at this point. And for as far as what kind of investing we've done, our Fund 3, which I see Eric Knight, who is on, he's one of our investors. Eric, great to see you here. He's also in Fund, in one of that fund along with me and many other angels. And we basically we had opened up that fund at the beginning of 2020. And believe it or not, we invested the fund in about 10 companies from that point to December. Actually, I think it was August of 2021. So we deployed those funds. We're starting a new fund, and also always looking for angel investors to join our group, whether they're in Connecticut or not. We now know that we can have a very broad base of investors, and with a lot of the snowbirds going to Florida, we're hopeful to gain new investors there that they can join the fund and invest in a lot of these great companies that we're seeing.
And take advantage of the angel tax credit, because you
That's
don't
what
have
we
to
love.
live here to do that.
Well, yes, and that's one thing that we look to when we're trying to entice folks, accredited investors, to join our angel group. We're very lucky here in Connecticut to have the angel investor tax credit, where you get a 25% return on, it basically de-risks your investment, because you pay Connecticut taxes and you get your 25% reduction there on credit on your taxes. Or if you don't pay Connecticut taxes, you can sell or transfer it. So we love Connecticut companies for that reason. And I think in our Fund 3, I think 7 of the 10 companies were Connecticut companies, because our LLC for the fund will get the tax credit. So that's a very very positive thing that we've had in place now for, I think 2013 is when that went into place, and we're thrilled with it.
Excellent. Thank you
CI
very much.
manages that. If anybody needs
Yes.
information, just I'll put my email in the chat. You can
Yes.
contact me.
I think that's a wonderful opportunity to entice more angels to step forward. And I've seen the number of people taking advantage of that opportunity. I want to switch to the question by the audience while we are. I see a number of questions on the chat box. I can repeat those. One question that came up, Mushan, you're more than welcome to unmute yourself and ask the question. Mushan is with a family office here that has made significant investments in a number of transactions, and he specifically is asking about in terms of valuation, Icon Therapeutics. I presume he's referring to this massive, large raise that happened. And John, this is in your neck of the wood. Maybe you can start us with that.
Yeah, I typically don't talk too much about specific companies, but I mean, if you look at it, if you look at on PitchBook, it looks like a 10x like step up, from their Series A to Series B. And I think it's just it's another idea that, yes, with overall poor performance in 2021, you may find some investors that are not your traditional venture folks stepping back, but you still have really interesting groups that are out there that want to make the bet on super interesting technology. They don't have to be traditional venture. And when those folks want to jump in, typically they're jumping in on top of something that's already venture funded. And that's, I think, that's kind of what you look at for some of these deals, where it's not your traditional folks who are coming into the next round, and maybe it's not your typical crossover folks that you've seen over the last 5 or 6 years, but you're seeing other folks that see the opportunity to get into really compelling, interesting technologies. And I think that's not going away. I just don't think we're going to see the wave of it that we saw over the last couple of years. That would be my.
I'll just
Yeah.
add a couple comments on that. So I think first, it is pretty cool technology, right? It's this kind of a 3D movie, right, inside the cell to look at these kind of protein interactions. But I think we also have seen the advent of kind of the R&D superstars, right, getting a lot of money. So Roger Perlmutter, I think anybody would put him, easily in a top 5, best R&D folks in history in terms of Amgen and Merck and what he's driven there. You see that with Hal Barron and Altos Labs, $3 billion of commitment. Well, Hal Barron was the head of R&D at Genentech. Calico recruited him, Google, then GSK recruited him. So you see a little bit of this branded superstars of R&D. They can command a lot of money. And this also happens with executives. If you look at Josh Belenker, who sold Loxo, right, got a lot of money for Treeline from Arch. Or if you look at, George Skangos, when he left Biogen, he got a boatload of money to start Vir. So I think you see a lot of that, to the extent that biotech has notable R&D superstars or executive leadership superstars, they tend to command that type of, dollars behind them.
Thank you. You mentioned Josh and Loxo. He was a Connecticut company, if you remember, based in Stanford that Eli Lilly acquired. Josh took some roles with Lilly, and he is back on the saddle again. He's no longer with Lilly, and he's cooking up the next one. Any other questions or comments? Feel free to unmute yourself, jump in. And if I see that people are typing their question while I'm reading those, Don, you had some comments about the investment in Connecticut. Would you like to elaborate on that question, please?
Yeah, thank you. So Jonathan, when you were showing your slide 9 in particular, the whole Northeast was a light blue, and you were talking about Boston area taking the lead, et cetera. And I'm curious, between Boston and New York and Connecticut in there, how do we fit in with the growth? And I know that I like to tell people per capita, we're a small state. We're never going to be as large as others. And sometimes we come out ahead when we look at it via a per capita basis.
Yeah, it's a great question. I wish I had that answer right off the top of my head, but the answer I do have is we have all that information. And so if you want to ping me after this, I'm happy to sort of give you, a blow by blow within the geography of Northeast, so you can get a sense of what that looks like. I'm happy to share that with you. Unfortunately, I don't recall off the top of my head sort of where Connecticut sort of stands on that.
No problem. Thank you.
Mostafa, I just wanted to highlight one thing to make sure it's clear. There is a lot of money still on the sidelines, what we call dry powder, a lot of funds that have closed their recent funds in the last 12 to 18 months. They're looking for good technologies. They're looking for early stage founding teams, entrepreneurs to invest in. We still have more than half of our capacity left for our second fund, which was over $500 million. And so even though we've talked about some of the shifting dynamics, I think one thing that you might see change, and Marianne highlighted this, they see valuations going up. I think one of the reasons we've seen valuations go up is that a lot of VCs and a lot of funds have gotten insensitive, right, to valuation because they can put more money to work. So for example, if they were worried about deploying their capital efficiently, they might have a situation where they're like, look, we'll invest $20 million into your $10 million pre-money company, okay? Well, if they feel that there is scarcity value or that this technology has many suitors, then they might say, well, instead of 10 million, you know what? We'll invest 35 million into your 20 million pre-money. That's how valuations go up. Their position sizes don't change much. They just are less sensitive. If they can write a $30 million check or a $40 million check, it makes it easier for them than to find twice as many good opportunities to invest in. And that's part of the dynamic. I don't think it's generally a good thing. I think they'll retrench back to more reasonable valuations. And I don't think we'll continue to see valuations of early stage companies go up. But the main thing is if you've got a good technology, you're a founding team, an entrepreneur, keep pounding the pavement because there is money out there. They might not want to invest as much. They might want to hear more about the plan. How are you going to create value? What are you going to do with this 15 million or 20 million that we write a check for, or a seed check of $1 million or 2 million or 3 million? But I just wanted to highlight there's a lot of shifting sands right now, but there's still a lot of money ready to deploy to Connecticut companies or any other companies elsewhere.
And I'll build on that, Chris. It's a great point. And so when you looked at that first venture fundraising slide, these are all dedicated venture funds, and their job is to deploy that capital. And all these funds have new capital under a new fund, and they need to deploy that. And I think what we've seen over time is that there is been a focus for a lot of these traditional venture folks to be thinking about a seed early Series A strategy, because that is how they're going to differentiate themselves from all the other folks out there. You sort of think about everybody's a service provider across this whole industry, even the early stage investors. And if you have a bunch of term sheets that are all at the same value, it's like, well, what do how are you going to decide which term sheet to take? And a lot of times it goes to the value over and beyond that. But I think what we're seeing is LPs have to figure out which investors they want to continue to support on the fundraising side. And so if you have a bunch of the folks that are all in the same company, that portfolio is looks very similar to the LPs. And so a lot of times, in the seed and Series A side is where they're company building and they're looking for unique opportunities to put money in and show sort of how they're different from the other folks that are out there. So I think there's a lot of money, and I think that money will continue to be focused early stage because that is how they differentiate themselves. And then in essence, that's how they're building their ownership early too.
Thank you. Richard, I see that you have a question about medical device area. Would you like to unmute yourself, or should I read it?
Sure.
Go
No,
ahead.
I can unmute. I am unmuted. Sorry, just as well I wasn't saying anything rude. When you talk about medical devices, obviously, interesting and exciting, but in a sense, there are two categories of medical devices, and that's oversimplifying it. But there's the traditionally high-tech robotic surgery, remote monitoring stuff, which obviously is sort of the glamour end of it, and that's interesting. But there's also the less glamorous, the bone screws and implantable meshes and so on, which traditionally haven't been glamorous. But with the introduction of new materials, new technologies, additive manufacturing, those kinds of things, there has been a shift towards significant, growth in the market. I don't know if that's reflected in growth in startups, but I know there are a lot of companies in that field. I see a lot of Minneapolis and stuff. They have what they call Medical Alley, which has a whole stack of companies there, and literally several hundred companies and catheters and all these really exciting stuff. So I'm just wondering if there's any perception that there is a change. Even Zimmer's sort of spinning off the Zimmer V or whatever they're calling it. And I'm curious as to whether you see there's a perception there of growth in the traditionally boring medical devices.
I think there's growth there, but what's interesting is, on the biopharma side, for example, there's a group of, let's say, 20 or 30 investors that do the vast majority of Series A for that whole sector. I think in the device side, it's more stratified than that. And so I think there's a lot of interest there. And I think what's really compelling is that you're seeing a lot more acquirers that are out there, because more acquirers, I think if there's anything on the device side that you've seen over time, it's that you had very limited acquirers down the road. And most of these companies just weren't in the capacity to build themselves into a standalone operating company on their own. And so really they were looking at M&A as their exit path. And when you only have like two suitors, it's a lot harder to figure out and get folks to engage earlier. So what I think now is what's happening is you're going to, with more acquirers out there, see a little bit more early stage acquisition activity in device. But I also think that on the early stage Series A, there is, I say there's like 20 to 30 on the biotech side. It feels like there's maybe 5 to 7 that are doing more than 2 or 3 deals a year. And so
Okay.
it's just harder. It's harder to find that right match on the device side, but I do feel like device is on the upswing in terms of interest level, just to the points that you've made.
Okay, thank you.
So thank you very much. Any other question from the audience? If not, we are going to go around the room and ask our panelists for the last word, whatever they like to say, a word of advice, word of prediction. And I start with myself because I want to show you how wrong I was in my prediction of how long COVID lasts. You know, when in March of 22, every morning we go down the driveway, there's a New York Times drop on our driveway. I said, I don't want to touch anything coming from New York. So I postponed our subscription by 6 months. I said, by 6 months, we are done with this. And I've gone through 3 postponements and still we're dealing with the same stuff. So I gave up with that prediction. So that shows my level of intelligence in the predicting of the duration of COVID. But setting that aside, I want to go from the other order, starting from Marianne to Cyndi and then other guests. Just any closing remarks, anything that you want to share with the audience. Go ahead, please, Marianne.
I think that for the startups that are in the room or the early stage companies, you know, conserve. You've over the last 2 years, you've really tried to conserve your cash, and you revisited your strategies to make sure that that whatever the impact of COVID was, that you could hopefully manage around it. And you probably did some pivoting. And I would tell you that even as we come out of COVID, continue to do that, because the companies that I saw that were able to make changes, you know, within days within weeks, they're the ones that really survived. The ones that really delayed their time in trying to make some decisions. What are we going to do? What are we going to change? They're the ones that really struggled. So really stay on point and pivot if you need to, because that is really critical in these early stage ventures. And also, if you're out there or looking to raise capital, get connected with the investors early. You know, if you are not planning to raise capital for 6 months, today is the day that you need to be connecting with angels, with CI here in Connecticut, and you can't connect with them early enough, because it's going to take a long time. And in today's day with COVID, and we're not meeting in person, you know, we're only meeting on Zoom meetings. It's going to take you a little bit longer to raise your capital. So get started on it. And for the women that are the entrepreneurs that are in the room, please don't hold off and make the connections. A lot of early stage gal entrepreneurs, when they're getting started, they feel like they really have to have everything in line and everything answered. And please, the guys don't do that, so don't put yourself behind them. Please try to do side by side and get out there early and get connected up with any angels or CI early on. That's my best advice, is get connected. And I'll put my name and Angel Investor Forum website do connect up with us, apply to us. And if you don't get monies right away, you might get some great mentors like Eric Knight, who happens to be on the call right now.
Thank you very much, Marianne. Cyndi, please.
Yeah, all really good comments, Marianne. And I think, you know, we do start looking at things very, very early, even, you know, sometimes before the company's there and there's outreach. So, you know, by all means, please reach out. You know, if you're bio, happy to connect with you personally. If you've got a relationship with somebody else at CI, you know, they'll lead the way. And women entrepreneurs, I think, you know, one thing that has kind of resulted from the whole past couple of years is the diversity, equity, inclusion that everybody is talking about and everybody is quite serious about. There are new new funds that are specifically targeting certain areas. There's other groups that are targeting in women investors. You know, connect. One of the things that CI does, and I think we do really well, is connect you with the community as well, because we can't do deals by ourselves. And so the more people you reach out to, the bigger your network is going to grow, and the more opportunity you're going to have, and you're going to have an opportunity to get feedback early, which can really help save a lot of time and help, you know, direct you early on. There's also some really good programs out there, and I think I saw Mary Howard's electrons in the chat. Design Technologies with their ABCT program is a great way of kind of, you know, learning the ropes if you're new to all this. I won't predict the crystal ball. I have to say, with the whole pandemic situation, when it first happened, I underplayed it a little bit, and as it came on, you realize like how really serious it is. I think the way that things go this next year is really going to be heavily dependent upon what happens with the pandemic, if it turns endemic, if there's another variant, how we handle it. There's a really good stat article Helen Branswell wrote, you know, kind of 10 things that we learned this year, and it's very insightful. You know, we've had some missteps. I'm cautiously optimistic that things will stay the way they're staying. I have to say, from an infectious disease standpoint, I'm a little worried about that. And I think that that could have a big impact on kind of where people are going to put their money.
Thanks, Cyndi. Chris, your turn.
Yeah, sure. Yeah. Again, overall, I mean, if I look back 2 years ago, we decided to lean in and really, focus on our investments. We deployed our first fund in 2020. We needed to raise fund 2 in early 2021. I think we're going to continue to do this, whether it's remote or whether we can meet in person another time, but we haven't stopped. And I think that there's, like I said earlier, a lot of opportunities for investment. I think as an entrepreneur, first, I did put my contact information in the chat, so feel free to reach out if you have an opportunity you want us to take a look at. But I would say that think about what money you want to raise and what you're going to do with it and how you're going to create value. Any investor is willing to write a check if you have a good plan, whether it's $500,000, whether it's $2 million, whether it's $10 million. You need to have a plan for creating, let's say, 5x or 10x value from that investment. So if you're raising 500,000, you better have a plan to make that worth 2.5 million or 5 million, right? And so it really doesn't matter how much you're asking for, it's what are you going to do with it? Can you create value, and will it make it easier to raise the next round? I think one of the things we've gotten distracted by with all the IPOs and all the valuations, people took their eye off the program and they were more focused on when's the next round? How much can I get? How much of a step up? Hey, can we sell? Can we go IPO and get a liquidity event? Just focus on the program and things will take care of itself. That's the parting wisdom.
Thank you very much, Chris. Now back to John, that created the whole problem today. You started, you better finish it.
Well, I mean, I just a couple of quick points. I think the other panelists really summed it up really nicely. I'll say one, I remember March of 2020, I ended up reaching out to a lot of investors to try and understand what things were going to look like. And a lot of them were actually thinking about, well, how am I going to triage my portfolio at that point in time? But I think it very quickly morphed into, you know what, everything is still okay, even though we are in a terrible pandemic. We're going to do our business because healthcare is important and we need to keep going. And I think that's what we saw. And I think it just shows the resilience of the whole healthcare sector as well, from the very early stage to the late stage. And the second point I would make is it's just so interesting to see tech-enabled services, computational bio, the sort of marrying of technology and data and healthcare together. I think that is really a really intriguing area to watch. And I think, bringing in additional capital from sort of the tech side that wants to leverage that into the healthcare side, I think is really intriguing, process. And I do think in 5 years, we're not even going to be mentioning the term computational bio. I think it's just going to be a part of the underlying, focus of ways to find ways to do things faster or better or cheaper or all three. And so I'm really intrigued about where things are going to go from here. And I'm very excited about, healthcare, even though we are in a little bit of a state of a downturn with some tougher times on the IPO market. I still think there's an incredible amount of capital out there. These investors are looking to do early stage. And for the companies that they're already in, they have dry powder. And what the one thing that I think people worry about is like, oh, look at all these, the tourist investors that have come in. If you look at the underlying company, even if it's a Series A or B company, typically there's 3 or 4 traditional venture folks that are there. They have dry powder. They will support the company if the company continues to progress in a way that they think is going to create value. So while 2008 was a different world, where there were people who had to make really tough choices, even in great companies that maybe didn't make it. I feel like in this time, even though we are having a little bit of a tougher time in the market, there's a lot of capital out there to support these companies. So I'm feeling pretty optimistic overall.
Thank you very much, everybody. I think the message that it was very loud and clear last time we spoke. There was an optimism that not everybody shared with you, but the panel was unanimous that they felt that there is a lot of opportunities and there's a lot of right side to what we have seen. I think John's numbers and the sentiment that you heard from the panel confirmed that that was the right sentiment. And I think based on what you heard, there is definitely a positive and bright pathway in front of us. I vividly recall when I was speaking with Nobar Afian, he's a co-founder and investor into Moderna. We had this dinner in Cambridge about 4 or 5 years ago. And when I asked about this approach that they were taking, he said, look, we don't know when we're going to get to clinic on this one. It's a risk that we are taking, but it's worth it. But, much faster than they anticipated, they're in the market and there is a pressure to produce more of what they are making. I want to thank again for the panel's time, for the gracious time they gave to us. As you notice in the chat box, they even provided their contact information. To me, that means that they are really in business. They are not here just to talk. They are here to speak with you, look at your ideas, and most likely you're going to hear, no, this is the chance that you get. But that's the feedback that Cyndi was mentioning. You got to go listen to the message and learn and come back with a refined message with the answer to those comments. I know that we have gone over our time. Thanks for everybody to joining us. And I promise we'll come back again maybe 2 years from now and we'll laugh at COVID perhaps then. Thank you very much.
So. Thanks, Mostafa. Thanks, everybody.
Thanks, everyone.
Have a great evening.
Thank you. Bye-bye.
Bye.
Thank you.